Mr. Chairman, thank you for your courtesy, and those of the members as well. I was on the floor on something that's incredibly important to New Jersey, which is the FDA reauthorization, as we are the medicine chest to the world. So I appreciate your courtesy, and I appreciate you and the ranking member holding this hearing, specifically on the Menendez Boxer legislation, which I think is incredibly important. As I've said many times, we need to fix the housing market in order to get the broader economy moving again and create jobs. And fixing the housing market has to involve multiple strategies to attack the problem from different angles. And to me, refinancing should be one of those strategies, particularly for borrowers who are making their payments, but whose interest rates on their mortgages are above today's interest rates of 4 to 5%. And that's why Senator Boxer and I introduced the Responsible Homeowner Financing Act of 2012. The goal of the bill is very simple. Any homeowner with a Fannie or Freddie loan should be able to get a pre-approved package in the mail from their lender, sign on the dotted line, and be automatically put into a refinance loan that saves them hundreds of dollars a month. No more lending bureaucracy, no more red tape. It should be simple for any homeowner to do this. That's why our bill is supported by borrower groups, by the National Association of Realtors, the National Association of Home Builders, many lenders like Quicken Loans, some mortgage investors like Amherst Securities, and by small business groups. Our bill will help the 17.5 million borrowers who have Fannie Mae and Freddie Mac loans but who are trapped paying interest rates above 5% because of barriers to that refinancing. Most estimates are that it is likely to help an additional 3 million borrowers to refinance, although that depends on how many borrowers actually take advantage of it. Our bill will make it easier for homeowners to refinance and lower their mortgage payments, which is both a popular and common sense way to help the housing market, and by the way, I would say help the economy as well. If I have that roof that has been leaking and all I can do is afford to patch it up, but now I have the wherewithal to fix it, I am going to both preserve my property, preserve its value, and at the same time, go ahead and hire somebody to do that, and that creates a ripple effect in our economy. Allowing a homeowner to refinance from a loan that's a 6% interest to a loan that's 4% interest, for example, would save them hundreds of dollars a month, putting more money in their pockets and reducing defaults and foreclosures. Some but not all of the refinancing barriers, I heard discussion here about what has already happened in FHFA's HARP expansion called HARP 2. Not all of the barriers to refinancing were addressed there. For example, HARP 2 removed loan-to-value caps for underwater homeowners, but doesn't apply to borrowers under 80% loan-to-value ratio, who theoretically should be able to refinance, but in practice sometimes cannot. My office has heard from New Jersey homeowners who are in exactly this situation. FHFA scaled back lender liability for representations and warranties, which lenders cite as an obstacle to encouraging them to extend refinance loans for same servicer refinancers in HARP 2, but they did not scale back representations and warranties liability for cases where a different servicer was refinancing the loan, which has led to a lack of competition among lenders that has resulted in much higher interest rates for borrowers, according to analysis from Amherst Securities and many others. Seems to me that's something I know many of my colleagues support, competition. We need to inject competition and market forces into this market where servicers have an unfair monopoly on refinancing certain borrowers who effectively have no choice but to use their original lender. Another obstacle, and I've heard discussion on this here today, is that second mortgage holders and one particular mortgage insurer, United Guarantee, do not always allow their interest to be transferred to a new refinance loan, even though they are generally better off when the first mortgage refinances to a lower payment, since that makes the loan less likely to default and the homeowner more likely to be able to pay the second mortgage as well. So I compliment the other mortgage insurers for working with FHFA to streamline these refinances and transfer their interest automatically. But United Guarantee is an AIG subsidiary, a TARP bailout recipient that has not agreed to do that, thereby hindering refinances and costing both homeowners and federal taxpayers money. It's pretty amazing to me. Another obstacle is upfront fees and appraisal costs that homeowners without savings can't afford, keep them trapped in high-interest loans. And yet another barrier is verification of income, tax returns, and other paperwork which is needed for new loans, but not necessary for refinance loans where the borrower is already making payments on time. And I was gratified to hear, Mr. Chairman, at our subcommittee hearing that I chaired a few weeks ago, from every witness representing all points of view that they didn't think this paperwork was necessary for refinance loans. For these Fannie and Freddie loans, taxpayers already own the risk if these homeowners default, regardless of whether we allow the homeowner to refinance or not. So stopping homeowners from refinancing into lower cost loans where they are less likely to default harms both homeowners and taxpayers and is obviously, in my mind, terrible policy. FHFA needs to change this now. This is urgent because we don't know how long those low interest rates will remain. And once interest rates rise, it won't make any sense for homeowners to refinance. Every day the FHFA and Congress delays is another day that both taxpayers and homeowners are losing millions of dollars. Finally, one of the best aspects of the Boxer-Menendez Responsible Homeowner Refinancing Act is that according to preliminary CBO estimates, it will stop bailouts, it will save taxpayers money because fewer homeowners will default with their mortgage payments are lowered. That means that it is not a cost according to that preliminary estimate. So, Mr. Chairman, I appreciate that opportunity, and I just have two questions. One is to Mr. Emerson. Do you believe that current HARP 2 policies give an advantage to the borrower's existing lender, thereby reducing competition among lenders and increasing interest rates for borrowers?
Senator, I believe that that's the case simply from the fact that it is, as you said, more difficult and more risky for a new originator to take on the rep and warrant risk associated with the way the loan is originated today, and that as a result of that, they're staying away from doing a lot of the HARP 2.0 loans. And I think another point that's important is velocity. And you mentioned, we don't know how long it's going to be before rates go up. We may get to $2.5 million or 2.5 million borrowers if we do nothing. But how long is it going to take to get there? And I think the sooner that we can act and open up the origination capabilities of the entire country to help these homeowners, the better opportunity we're going to help more of them faster and make sure that they get into the low rates that exist today.
Well, it seems that only the FHFA are about the only ones who think that HARP 2 isn't limiting competition. Let me ask Mr. Veissi and, for that fact, anyone who wants to join in. Another obstacle to refinancing is that second mortgage holders, as I said, and mortgage insurers do not always allow their interest to be transferred to a new refinance loan, even though they are better off than when the first mortgage refinances to a lower payment, since that makes the loan less likely to default and the homeowner more likely to be able to pay the second mortgage. Does it make sense to require automatic portability to the refinance loan? Could you put your mic?
I'm sorry. That's an interesting concept. What we hear, Senator, across the board is a little bit different than the statistical evidence that you get, and I deal with folks from California to New Jersey and back down to Florida again across the country, and we're hearing again and again that secondary financing in many cases holds up both refinancing and in many cases sales. I'd have to think about the answer to that question and maybe confer with you, but my knee-jerk may be that that might be an interesting opportunity.
Mr. Emerson, what do you think?
I think we're open to looking at how we make that process better from a subordination perspective. I do think that there are a lot of second lien holders that are subordinating. I think, though, that the problem is in the process it becomes very cumbersome. It's very there's a time delay in the information. Many times you're not, with this HARP program, you're not utilizing an appraisal because there's no need to. But when you subordinate, the second lien holder requires that appraisal. And so you now have to go out and get charge additional monies to get an appraisal when you don't need it for the first lien. So while I do think that a lot of people a lot of lenders are subordinating, the process itself needs to be dramatically improved. We hear that every day from homeowners. So some form, I don't know if portability is the right answer, but we do need to figure out a way to make that process a little more streamlined.
Would our bill largely take care of most of what you're concerned about in the context of the process?
based off of what I've read so far, I think it goes a long way to getting there, yes.
Finally, Mr. Zandi, I'm not sure if you saw the Federal Lender Survey that came out recently, but it indicates that mortgage insurance and second liens are, in fact, obstacles to HARP refinancing, and I would call your attention to it because I do believe this is one of our challenges in moving forward, and that survey made it pretty clear that these are elements of a real challenge, and that's something we'd seek to take on in terms of the legislation.
Can I just make one quick point? I think the legislation, the key points of the legislation are very good, and if enacted quickly, given the rate environment, are going to have a very significant impact. I think, though, to try to complicate it in any way, unless it's absolutely clear that that's going to make it better, is a mistake, because it's going to slow things down, it's not going to get done, and you're going to lose your window. So you got to, I err on the side of being parsimonious here and getting what can be done, because we're really close to generating a lot of refinancing activity.
Thank you for your encouragement, Mr.